Petty cash funds refers to an amount of cash kept on hand to pay for minor expenditures. So why do businesses use petty cash funds? While most companies require all disbursements of cash be made with an authorized electronic transfer or double-signed check, for minor amounts of cash expenditure, checks are inefficient and may not be accepted. Minor expenditures can encompass expenses such as postage for small mailings, office supplies, and miscellaneous items such as a gift to a client. Whilst the scope and size of a petty cash fund will vary across businesses, all petty cash funds involve three core activities, which are establishing the fund, making payments from the fund, and replenishing the fund. Establishing the fund involves writing a check for the amount of the fund, cashing the check, and placing the cash under the care of an employee designated as a custodian. A journal entry is then made to record the establishment of the fund. So let's look at an example. On April 1st, Business A cashes a $150 check to establish a petty cash fund. This entry increases petty cash and decreases cash. However, it is important to note that there is no net change in total assets as the cash has been designated to the fund but is still with the business. Now that the fund has been established, cash can now be used to pay for qualifying expenditures. Payments are usually made in one of two ways. Cash can be taken from the fund to make the payment, or employees seek reimbursement from the fund for payments they have made personally. At this step, no journal entries are made, only in the next step when the fund is replenished. When the fund requires more cash, the custodian requests a check for the difference between the cash on hand and the total assigned to the fund. To do this, the remaining cash in the fund is counted, receipts are collected and verified for legitimacy, and the business cashes a check for the amount that brings the total cash in the fund back to the original balance. This journal entry shows that a $130 check is needed to return the total cash in the fund back to its original balance. This requires debiting all relevant asset or expense accounts and crediting cash. In this case, the office supplies, postage, and transportation accounts are debited and the cash account is credited. This entry also reduces both assets and equity as expenses have now been accounted for by the fund. Whilst the amount of cash needed for replenishment of the fund should equal the total number of receipts, this does not always happen, resulting in discrepancies between the amount of cash needed for replenishment and the amount of receipts. This difference is recorded in the cash over and short account. The account is debited when there is a cash shortage and credited when there is a cash surplus. In this example, the receipts total $130, but the fund needs $135. So the cash over and short is debited for $5 as there is a cash shortage.